Hey everyone, I'm super excited to be talking with Nick Piquard very shortly from Hamilton ETFs. In case you didn't know, Nick Piquard, this guy right here, is the chief options strategist for Hamilton ETFs. So he's really the brains behind their yield maximizer ETFs, which we all know and love. These are income first ETFs, right? Covered call ETFs. They have a whole bunch of them now covering many sectors, including utilities and Canadian banks and technology, US equity, healthcare, US financials, energy, gold producers, etc. And this is a really in-depth Q&A where we're going to talk about the covered call strategy in detail, Hamilton's view on covered calls. We're going to talk about some of their ETFs. Why are they increasing and decreasing some of their distribution? So we're going to talk a little bit about that. Which I know is very important for you guys who are reliant on these monthly distributions. What's the difference between Hamilton ETFs versus the competition? The difference in strategy? How do covered call ETFs act and behave in a volatile market? What are the advantages of having covered calls? So all kinds of great topics, guys. I'm super excited about this. Let's get to it. Let's talk to Nick Piquard right now. Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got Nick Piquard from Hamilton ETFs, who's their options specialist, really head of options. How's it going, Nick?
Good. You good? Nice to be here.
Yeah, it's good to have you back on the channel. Such a renowned options specialist in Canada with all that experience. So we're going to do some maybe deep diving into options and volatility, and then Hamilton's view on the recent volatility and how covered call ETFs behave during this volatility. So I'm very excited for this conversation. It's going to be an education fest for covered call ETF investors. So let's start with we always see on websites, on covered call ETF websites, something like, when you're looking at covered call ETFs, it lowers volatility. So can you just explain how exactly do writing covered calls lower your volatility in your portfolio?
Yeah, sure. That's a common question because, how does a covered call strategy, lower volatility? And basically the way it lowers volatility is because the option call that you're selling is an offsetting position to your underlying stock. And so as the stock goes up, you're not going to participate as much of the upside because you've sold the upside for a premium. But then on the way down, you have that premium as a cushion. And so as your stock goes down, the value of the call goes down as well. So there's always an offset between as the stock goes higher, the value of the call is higher. As the stock goes lower, the value of the call is lower. And so that lowers the volatility of the portfolio. And what you'll find is, the more options you'll sell, the more the coverage, the more that will reduce volatility. And the other thing you want to think about is, the higher out of the money you're selling your call. So if you have a higher strike, you're going to get less premium. That's going to lower your volatility somewhat less. So, when you're selling options that are close to where the stock is, that actually has a more mitigating impact on overall volatility.
Makes perfect sense. So the more out of the money it is, the less upside you're selling. And you mentioned that perfectly, and that's a really cool way to describe call writing. You're selling upside, and the more out of the money it is, the more upside you're sorry, I'm getting mixed up here, but you're not selling as much upside if you're going more out of the money. So the mitigation, the cushion is less. But you're going to capture more of the upside if the stock goes up.
Exactly. And, and so that's the mechanism by which, the volatility gets lowered, but also it makes you think about, what are the different strategies in covered calls, whether it's better to, allow for more growth with, some out of the money calls, but accept higher volatility, or, sell more at the money calls. And we'll get into that more later, I'm sure. Where it's going to lower volatility more, and you're getting higher premiums,
right,
and better yields.
Okay, let's talk about April. So there was a lot of volatility in April. Now it's calming down, and just for the record, we're filming this in mid-May here. So the markets are starting, have recovered somewhat, or recovering, had a pretty good week. But April was pretty brutal. I mean, there was a lot of that the tariff news, and there was a lot of volatility. Some days we were down hard, and then the next day we were up hard. So, as a portfolio manager, and I know you guys take an active approach when it comes to cover call writing, how do you capitalize during that time where there's a higher volatility?
Yeah, and it's actually a very tricky environment for any trader. Whether you're trading options or not trading options, when you get these very very volatile periods. The big advantage of the high volatility environment for a covered call writer is that you're getting so much more premium for your options. The volatility, like the VIX, which is the measure of the market volatility, it went to, I believe, over 50 in that period, which is a level we hadn't seen since COVID, basically. And even if you go back over many years, it's very rare to get these kind of levels of volatility. So the advantage is you're going to get a lot of premium for your underlying options. The bad news, of course, is that the stocks are so much lower. And so if you're selling calls, like we talked about earlier, you're selling that upside. And so as things recover, you run the risk of being able to, not being able to participate into the recovery. And so how we manage that kind of situation is by reducing the number of calls that we sell. And so, yeah, actually, I see that you brought up your chart there. We see that the VIX hit a very high level, over 50.
Yeah.
But as the market recovers, you, as a covered call manager, you want to make sure you're still getting appropriate amount of upside on the underlying portfolio. And so what we're able to do is we reduce our coverage on the options that we're selling, which means we get less premium. But because the value of the options is so much higher, we don't need to write as much to get the yields that we're looking for. We're looking for 12 to 13% yields on many of our products. So we don't need, instead of writing 40%, we may only need to write 20%. And so that's how we kind of adjust for this kind of a volatile environment. Because by only writing 20%, then when things recover, we're able to capture more of that upside. But regardless, for any trader, it is tricky. It is a time where you want to be watching the markets, every day, being able to adjust your portfolio, being able to reduce some of the coverage where appropriate or add more when appropriate. But generally, this is where covered calls can do well for you, better than not having a covered call strategy.
Interesting. Okay, so you guys tend to have kind of a set target, like you mentioned, in the early teen yield range on a lot of your yield maximizer products. So you're not going to write at the same level, because normally the in regular environment, you guys are writing at the money calls on 30% of the portfolio. So instead of leaving it that way, you'll write maybe on a little bit less, you'll get the same amount of premium. But if the market starts rocketing up, which is typical eventually after a period of high volatility, you'll capture more of that upside. Do I have that right?
You have that exactly right. And the other way we can kind of mitigate some of the risks is by having various expiries. Instead of having all our options expire at the same time, we'll have them expire over different weeks of the month. So I think the low of the sell-off was right around regular expiry. I think it was, if you pull up a chart of the NASDAQ, you can see around which point the low of the market was. And it would be tricky to have all your options expire right at that time and then give up some of that upside. So by having only a portion of our options expiring at each expiry, we can stagger our strikes and stagger the premium that we're getting.
Okay, you're staggering your strike prices, your options in that case. And I'm just curious, what do you mean by a regular expiry? What does that mean?
Yeah, so the regular expiry is basically the third Friday of the month.
Third Friday. I've heard that before.
Yeah.
I never knew
Yeah. So that's a very good point. Yeah. So normally, and in the trader lingo, sometimes they'll refer to triple witching or quadruple witching, and that is every quarter, the third Friday of the month, you got futures expiring, you have index options expiring, you have single stock options expiring, and you have single stock futures expiring, and so all of that creates a lot of trading, a lot of volatility in many cases. And so, we try to trade, we try to avoid some of these days if they're going to be very volatile and try to trade around maybe a little bit before, maybe a little bit after. But definitely that third Friday of every month is usually a day where you'll see different types of trading that you don't normally see, at other times.
Oh, interesting. I didn't know that. Okay, cool. So call premiums, we know they're based, well, that you correct me if I'm wrong on this. They're based on two things: of volatility and net asset value or stock prices. From my experience of watching all these covered call ETFs for years now, it's clear to me that if typically, I'm saying typically, if a covered call ETF, let's just say like SMAX or QMAX or anyone, just keeps going up and up and up. The market's doing really well. They go up, 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 and volatility remains more or less the same. You guys tend, or normally the distributions tend to increase over time as well, right?
Yeah,
So in
absolutely.
in April, so there was that big spike in volatility. I noticed that, for example, SMAX and QMAX, your latest distributions, were reduced a little bit. So if volatility is higher, you're taking in more premium. Why the slight distribution reductions? I think the audience
Yeah.
would probably be curious
That's
about
a,
that.
an excellent question, and it is related to the how we adjust our coverage and how we trade the cover call strategy. So most options, when you think about them, they're priced in terms of yield. So when we're saying, oh, we're targeting a specific yield, say 12% a year,
Yeah.
we're trying to get 1% a month. Every month we're trying to get you 1%, and then that's what we're able to distribute. Um, by having a target yield, we feel like it's more sustainable kind of over the long term, because as stocks go higher, you're still going to be able to get your yield, and that's going to be a higher distribution. But as stocks go lower, it would be very difficult to maintain a fixed distribution. And especially, if for some reason stocks go a lot lower. And that's where you can get into a little bit of trouble. You'd have to write more, or you'd have to go over and beyond what you really want to do. And so with this situation here, because the NAV was down, because the market was down, the volatility did go up, and we were able to get more premium, but we wrote less of those options in anticipation that when things recover, we're going to get more of that upside. And so we're still getting the same yield, but it will reflect as a slightly lower distribution for you as a unit holder.
Makes
But
sense.
as things recover, we would expect that distribution to vary again. And there's going to be some modest variability, but it will change, as the NAV change and as our coverage changes. So we try to, even though the volatility is not necessarily a bad thing for the cover call strategy because of the higher premiums, we do try to shield the distributions from all those changes in volatility by adjusting our coverage accordingly.
Okay, that makes perfect sense. And this is where the active management comes in. You guys are not doing a rinse and repeat every single month like some providers. So what's more of an important factor? The volatility, the NAV? Is it like 50-50, 80-20? Like what's more important, or what dictates more the distribution? Is it the NAV decline or increase, or is it the volatility decrease or increase?
Yeah, I mean, both volatility and NAV are important in general for option pricing. But in our case, because we're adjusting dynamically our coverage to adjust for the volatility changes, volatility is not going to be as important a contributor actually to the our distributions. NAV is going to be more important because
Okay.
we're making these conscious decisions to adjust for our coverage based on the volatility. If, for example, I'd maintain we have a 30% coverage on average, say on QMAX. If we'd written QMAX at 30% last month, we would have probably had to close to double our distribution, maybe not double, but significantly higher, because we would have raised so much more premium. But instead, we were able to lower our coverage, and as the Nasdaq since in the last couple of weeks is up close to 10%, depending on which stocks you're looking at, and many of the stocks in QMAX are up significantly. And so by having that lower coverage, you're long term, we think it works out better for the investors.
Interesting. And these are not like massive variations either, right? Up
No.
or down. They don't vary. Like I'm showing QMAX here, by the way. This is your technology one where you have, pretty tech stocks are typically very volatile. Some obviously more than others. But it goes to your point, right? That you'll get that variability, yes, but it's not like it's crazy variability. So
Yeah, like for example, Palantir, which is one of the stocks in our portfolio.
yeah, it's right at the top there.
At the top there.
Yeah.
It's up. The reason the weight is up right now is because it's up 25% or something like that in the last couple weeks. And so if we were, we would never be 100% written on anything. But even if we were 30% written on this stock, we would have given up a lot more of the upside. Than it, but that we would have, normally. So it's we're really trying to get the premium for the funds, get our target distributions, but we don't need more than that. And that means that, when the markets recover, that protects the NAV a little bit more.
Yeah, interesting. Okay. So there's a lot of competition out there, especially in Canada. The US is growing as well, but in Canada, there's plenty of competition in terms of cover call ETFs. What would you say makes Hamilton, your strategy stand out versus the competition?
Yeah, I mean, look, I think the active management is definitely one of the ways that we stand out. I think we have one of the best teams on the cover call space in terms of management. We have a team of 5 led by myself. I have over 25 years of experience trading options, and my background is pretty unique in terms of portfolio management because I spent the first half of my career as an options trader. So I was the one making the prices on the exchange for the clients. And so I really understand how the buyers of the option, the market makers, how they view the world, how they make money when there's a volatility in the market, and what I need to do to make sure I get the best price for the client. So I think that gives me an advantage in terms of, as a portfolio manager now on the buy side, having come from the sell side, I understand how the market makers do their prices and how to get the most premium every time I sell a call option. So that I think having that background really, it takes years and years of experience, to really, watching the markets, like I said, that third Friday of the month. If I hadn't done that for very long, I'd be like, well, what difference does it make? It's just another day. But when you've been through a lot of these expiry Fridays and you see how it can really change the dynamics of the trading, you know that you want to be able to compensate for that. So there's a lot of reasons why we think active management works better, and I think Hamilton it does this very well. But also we're very focused on maximizing income, which means writing the at the money options, and also offering all the sectors and exposures that clients would want to supplement their the income in their portfolio. We offer energy, we offer gold, we offer technology, we offer banks, utilities. So, we can, with our suite of products, you can cover a lot of the different sectors. We recently launched our RMAX, which is real estate covered call using REITs,
Yeah.
both U.S. and Canadian REITs, and we think that's a great addition to diversify your portfolio. And then we have our fixed income covered calls, which we were the first to launch, where you can use the covered call strategy on the fixed income side. So I think the broad sectors and exposures that we offer, with the focus on maximizing yield, which means we write at the money options. I think that's what kind of differentiates us from everyone else.
Yeah, you got all the sector, most of the sectors covered, I would say, in the yield maximizer line. Of course, you have H yield and H div, which are kind of like the all-in-ones.
Yes.
So let's talk a little bit about the distributions. That's very important for my community because a lot of, including myself, either thinking about retiring, trying to supplement your retirement income, you're really reliant on these distributions. We know that the yield maximizer ETFs do have variance month to month. Either they go up, either they go down. So how should investors see these distribution increases or decreases? Or another way I could ask, you already talked about what would cause you to increase or decrease the distributions. Tell me a little bit how, distribution policy, how these are decided and how investors should view increases or decreases.
Yeah, and we touched on it a little bit earlier, but basically a lot of the variability that you're going to see in our distributions is because of our strategy of targeting yield. And so because we're trying to target yield, and it's not going to be a perfect match, and there's always going to be some variability based on factors such as the timing of when things expire or the volatility on a specific month or week or whatnot. But overall, what we're trying to do is really use our target yields as a metric for the distributions. So what that means, though, in practice, is as stocks go higher, if you have a fixed distribution, your yield is going to be lower. So I mean, we can afford to pay more because we're getting more for our option premiums. So we're going to slowly increase. We don't want to create extra variability, but we want to increase the distribution somewhat. Similarly, on the way down, we want to make sure these are sustainable distributions over time. And so we don't want to say, we're going to pay a fixed amount, and then after 6 months, we're like, you know what, we got to do a big cut because we can't afford this much higher yield that we've been trying to achieve. So we'd rather smooth things out on the way up. Every month there's going to be a little bit of a change. We want to make sure investors are conscious of the fact that these are stock portfolios.
Exactly.
They're not bonds in this. I mean, we have H bond, but for the stock portfolios in particular, these can be volatile sectors, and so there is going to be you should expect a little bit of variability, in the distributions. But we think that because it's a modest change, as long as you can say hey, I can expect to get this certain yield, then that should be enough. If I like this sector, I'm not expecting it to be down significantly. I should feel comfortable that I'm going to get those distributions.
It's masterclass we're going through here with options and distributions and management. It's great. So if you don't mind, I would love to take 3 of the top member questions that I got. Everyone's always excited when they know I'm about to talk to Nick Piquard, of course, from Hamilton. So I chose the 3 most voted questions. So let's go through the first one. The first question I get all the time in different ways, or it's worded differently, and I can't think of a better person to ask than you because you have a lot of experience in the industry, the options market, and you went through your background. You've been in the game for a long time. And I'm sure you got this question as well. Here it is. The covered call ETF market seems to be getting crowded, right? Every week there's new covered call ETFs. Will this not lead to diminished returns on the calls, or is there still room to grow? So I'm sure you get many variations of this question. I get it all the time.
Yeah.
What happens
Yeah.
when nobody buys calls, or who's buying these calls? I get it a million different ways.
Yeah.
What would you say to this question?
Well, I say there's the the value of those calls is not just driven by supply and demand in the call options market or the options market in general. What really drives the value of those calls is the underlying volatility of the market. And so, if call prices get too cheap versus the underlying volatility of the market, you're going to have arbitrageurs and market makers who are coming in to buy those cheap options and against a more volatile market. So there's always, as long as markets remain volatile, there's going to be a bid,
Yeah.
for those call options. So I think, and that's my background as a sell side options trader, where I was the buyer of the options. I can tell you with frankly that hey, when volatility gets cheap and you can buy these options at a good price, for sure there's going to be a lot of competition to buy. And so for the this is good news for the option seller, because as long as there's some volatility in the market, there's going to be value to the call options. Now, the second part of that question, though, or the second part of the answer, I guess, is the execution part. If you need to sell all your call options at a specific time on a specific day, then you might run into a little bit of trouble, because there might not be enough liquidity for you right at that time. So, in order to get the best price, maybe the better strategy is to spread out your trade, make sure that the buyer can slowly, adjust his book to buyer volatility. And now you're not just, selling everything all at once and creating a bit of an imbalance in supply and demand. So I think, it's a very good question, because there is a lot of call selling now, and these products have attracted a lot of money, even though, outside of ETFs, there's been lots of covered call writing, in the past several decades. But what's really driving these call premiums and the value of the call option is the underlying volatility. And so, as a percentage, covered calls as a percentage of overall ETFs, it's just such a small portion of the equity world,
Right.
that we'd almost have very, very little impact on option pricing. However, it is smart, I think, and a better strategy to, if you have a big trade on a stock that's not super liquid, to manage that process. Just like selling any stock, if you're going to sell 100,000 shares of a stock that trades 20,000 shares a day, you're not going to do it in one day. You're going to stagger that trade over a few weeks and make sure you don't have too much market impact. Same thing on the option side. We want to minimize market impact, which is why I think active management is important.
Yeah, that's a great answer. And yeah, I think about it all the time. As long as there's human emotion, as long as humans have emotion, there's going to be volatility, because volatility
100%.
is you hear that all, fear and greed. That's the two human emotions. Sometimes I think in the back of my head, well, what if AI takes over the trading and they don't have emotion? But then I'm like, well, AI learns from humans, and humans have emotion. So I'm not even worried about AI or anything. But that's maybe in 10 years we'll have this conversation. But I appreciate your answer.
Yeah, and even on top of the human emotion, what drives a lot of volatility is uncertainty over announcements. Like what's the tariffs going to be next? What is there going to be economic growth? Is there is there going to be some political incident? It's hard to predict all these things, but there's always a probability of that happening, and so the markets are always moving based on those changing uncertainties.
Yeah, and those are my favorite times personally, because I'm a long-term buy and hold investor. So I love when there's uncertainty in uncertainty, because I could just buy cheaper shares and grow my income. I buy more shares every single month, no matter what. So I'm growing my income every month. But if there's uncertainty and there's a drop, I literally am accelerating my income growth,
Yeah, and
right?
you're getting a
So
better deal, getting these stocks on sale, right?
exactly, exactly. This is why it's always like, why, who's selling everything? But anyway, that's probably a discussion for another time. I would
Yeah,
love to pick your
definitely a
brain
long,
about that.
long, long conversation for that.
Yeah, I would love to pick your brain about that too. Okay, next question, and this is a good one. This is a pretty makes sense. This request: can Hamilton add more transparency and actually publish the calls that they will write for the coming month and on what percentage of the portfolio on the website? Many U.S. ETFs are doing it now, so you see a lot of ETF web pages. You actually go in the portfolio. There's not many in Canada. I think there's only one that does it. You'll actually see all the call options, strike prices, expiry dates. Have you guys thought about doing this?
Yeah, I mean, look, we don't do it for a couple reasons. We think it's, the investor and the unit holder is better off if we don't share that information, because we want to make sure that, if we have a big position and we need to buy back those options, or the market knows that we need to sell certain options, then what ends up happening is that, we might make it more difficult for us to execute on that trade. And
Interesting.
so, and we think it's better for the value of the fund if we don't share that information with the market. However, we're very transparent in our strategy,
Yeah.
and so you can feel comfortable with how we're executing the strategy via the yields that we're targeting, and via our coverage, and in what we're targeting, and how we implement the strategy using at the money call options. So I think our strategy is quite transparent in how we approach the market and how we want to do things. But in terms of the granularity, I don't know if it's really adding that much to to the end investor in terms of knowing whether to buy or not buy our ETF. And in terms of execution, which we think is very important, because you can every time you can execute a trade and save a few cents here and a few cents there, because we're trading every month, that can really add up, and we'd rather not share that.
Yeah, interesting. I know it makes complete sense to me. And I mean, the only reason I like it personally, it's not because I'm looking at what the strike price is, or I'm like babysitting, are they doing a good job? It's more just to show people a call option and how it is. That's, for
Yeah.
me, it's just educational. I can make a video about, but I'm not looking at all the calls and looking, okay, is it really and at the money or out of the money? Like I trust that you're active, you're the expert, not me. So but anyway, last question. This was the top voted question. We kind of touched upon it already, but maybe you'll have a different take on it. I'll ask you anyway. I would be interested to hear Nick's take on why we should still choose Hamilton ETFs over all the new ones out there. In what ways does he feel Hamilton outshines the rest?
Yeah. Well, and we touched on that a little bit, but I think that having a very experienced team, and that does active management, is a real benefit in a covered call writing strategy. And we're not doing any stock picking. Our underlying baskets are pretty systematic. We buy all the largest names. So we're
Yeah.
not we're not doing any active stock picking management. But on the underlying call options, and how to execute that strategy, we think that there's a lot of value in doing the active management, which for a lot of the reasons that I went through already, in terms of spreading your trades, spreading your expiries, looking for the best time to execute and get the best possible price. And we have this deep bench of professionals. We actually just added to our group Vern Roberts, who led the cover call effort at a competitor, and he's joined us. He's got tons of experience. We're very very excited to have him on board. I've known Vern for a long time, and we have a group of five of us who are working every day to maximize your yield. So I think that's the number one reason why you'd want to go with Hamilton. But in addition, we have a very broad sector of ETFs that covers all the sectors,
Yeah.
various asset classes, and then we have our all-in-ones that you mentioned earlier with H-Yield and HDIV. So I think those are my main reasons, at least when I talk to investors, and why they should really look at us in terms of looking for extra yield for their portfolios.
Awesome. Awesome. And maybe just one last question. I know I asked you this before, but I'm wondering maybe an updated opinion on this. Zero DTE options. You're in the space, you're monitoring the space a lot more than me. I'm only monitoring the covered call ETF space, not the options market. But do you feel like in the last couple of months it's gotten more interesting? Are you guys looking into it? What's your overall opinion and feeling about these zero DTE options, which right now I think are just on the three major indexes in the US?
Yeah, I mean, the zero day to expiry options have gotten so much volume these days. It seems like a lot of the volume in the options market is now trading in these options. Look, launching a product like that, it would be a lot of work. There's a lot of things involved in terms of selling the option every day, rolling those options every day. It is a lot more work. Already we spend a lot of work on doing options that expire every month.
Right.
but having an option that expires every day would be a lot of work. But look, it is an interesting idea. I know that they've launched it. I've launched a few of those products in the US. But even in the US, when you look at the products that they've launched, they had to do some kind of funny things where they buy an in the money call, and then they're selling kind of an at the money call. That like there's a few hoops that they had to do it to
Yeah.
kind of launch their product. So it's not super straightforward.
Interesting take. Okay, well, Nick, this has been a great conversation as always, and I'm speaking to the audience here. I hope you guys enjoy it. Give a thumbs up on the video if you did. Leave a comment if you have a question for Nick. Maybe we'll do it next time. And if you're interested in submitting your questions for the next interview, make sure to join the membership. Click on that little join button. So, Nick, thanks again so much for your time. Really appreciate it, and hope to talk again soon.
Yeah, it was a pleasure talking with you. Take care.
All right. Have a good weekend, man. Take care.